In Chapter 9, we will examine long-term liabilities. We begin with a discussion of a company's financing alternatives. A company can either borrow money, or it can have money contributed to the business by its owners, that is, an investment from stockholders. The degree to which a company uses one over the other is referred to as the company's capital structure, that is, its mix of liabilities versus equity that's used to finance the company's resources. Why would a company choose to borrow rather than issue additional stock? There are two primary reasons. One is that interest expense is tax deductible, whereas dividends that are paid to stockholders are not deductible. Because interest is deductible, it reduces the amount of taxes that a company must pay and thereby increases the company's cash resources. A second reason is that debt does not dilute a stockholder's claim to the ownership interest in the company. Imagine you and I start a company and we each own 50%. If we want to finance growth in the company, if we use debt, you and I each retain 50% ownership in the company. If, however, we issue additional shares, our ownership interest in the company is diminished, and we get a smaller piece of the pie. While using debt maintains our ownership interest in the company and therefore is generally preferable, companies may not always be able to use debt. One reason is that it increases the company's risk of bankruptcy. As more and more money is borrowed, the debt and interest that is obligated to be repaid increases the burden on our cash resources. If times don't go well, we may run into bankruptcy problems because the debt and interest payments are fixed. There is no discretion. A dividend, however, can be paid at the discretion of the company, and if times are tough, does not have to be made. Before discussing bond pricing, let's first clarify what is a bond. A bond is a formal debt instrument that obligates the borrower to repay a stated amount at a specific time, that is, the maturity date. The company, which is borrowing money, is usually issuing the bond to many lenders at the same time. The lenders can be individuals or another company. In any event, the borrower is agreeing to pay interest over the life of the bond, typically semi-annually, and then at the end of the bond's life, that is at its maturity date, the borrower is obligated to repay the stated amount, often referred to as principal or face amount. To understand bond pricing, we have to think about the nature of these cash flows. Today is the date at which the company is borrowing money. The question is, how much money is the lender willing to lend to us in exchange for two things? First, there is the promise to be repaid face value at the end of the bond's maturity. For example, 10 years. The lender has to wait 10 years to receive the face value. During the life of the bond, the lender is going to be entitled to receive interest payments, typically every 6 months. The question we must address is, what is the value of these payments today? The mechanics require that we calculate the present value of the face amount plus present value of periodic interest payments. We will see that bonds can be issued at face amount or amounts below or above the face value. These are referred to as discount and premium bonds. The information required to price a bond includes the stated rate of interest, which is the rate quoted on the bond contract. This is the rate used to calculate the semi-annual cash payments for interest. We will need to know the periods to maturity, which is the number of years multiplied by the number of interest payments per year. For a semi-annual bond, that is 2 payments per year. Lastly, we will need the market rate of interest. The market rate of interest is the true interest rate paid by the company and the price demanded by the investors. It is important to distinguish between stated rate and market rate, as we will illustrate here. To calculate the present value, we'll need to use two present value tables found at the back of the text. We will use table 2 when we are pricing the face value, that is, one singular cash flow. We will use table 4 when we are calculating the interest payments, because they recur every 6 months. They are said to be an annuity. There are multiple payments over the life of the bond. Look at the table and you will notice that we have both an N and an I. The N is the number of periods, which will be our number of years multiplied by 2 payments per year in the case of a semi-annual bond. The interest rate that we will use is the market rate of interest. We will need to divide by 2 to reflect the semi-annual nature of the interest payments. Let's look at an example. Let's assume RC Enterprises issues bonds. The face amount equals $100,000 and the stated rate is 7%. Let's assume that the market rate is also 7% and that the bond's term is 10 years with semi-annual interest payments. Step 1 is to calculate the present value of the face amount. For this, we will use Table 2. N equals 20, which is equal to the 10 years times 2 semi-annual payments per year, and using 3.5%, which is our 7% market rate, divided by 2 to reflect the semi-annual nature of the bond. The present value of the $100,000 face amount is $50,257. The $50,257 reflects the value today of the $100,000 that will be paid 10 years from now. Step 2 is to calculate the present value of the interest payments. For this, we will use Table 4. But first, we must determine what is the interest payment. The interest payment is calculated by taking the face value multiplied by the stated rate, not the market rate, but the stated rate. This is the amount stated on the bond. It is the fixed amount that the company is obligated to make every 6 months. To calculate today's value of these 20 cash payments that will be made, we go to Table 4. Our N is 20, same as before, 10 years times 2 per year, and the 7% market rate divided by 2. The factor in the table is 14.2124, and the present value of the interest payments is equal to $40,743. The total issue price of the bonds is therefore $100,000. That is equal to the present value of the face amount plus the present value of the interest payments. Notice that when the stated rate is equal to the market rate, the issue price is the same as the face value of the bond. With example 2, let's examine the bond issued at a discount. Now we will assume that the market rate is 8%. The 7% bonds are less attractive because other bonds in the marketplace offer a higher rate. In order to entice lenders to purchase our bonds, we will have to issue the bonds in an amount below face value. Let's compute the issue price using this new set of facts. Step 1, we will calculate the present value of the face amount. For this, we need to go to Table 2. Our N is 20, which is the 10 years times the 2 semi-annual interest payments. The I is our market rate of interest, which is the 8% divided by 2. The factor in Table 2 is 0.45639. Present value of our face amount is the $100,000 multiplied by this factor. We get 45,639. Step 2 is the present value of the interest payments. Recall, is face times stated rate times 1/2, $3,500, because we have $100,000 face and our stated rate is 7%. To price the interest payments, we need to go to Table 4. Our N is 20, our I is 4%, which recall is our market rate of interest divided by 2. The factor in the table is 13,59033. Gives us a value of 47,566. The total value of the bond, when the market rate of interest is 8% and the stated rate only 7%, we see that the bond will issue at a discount. Lastly, let's look at an example where the stated rate of interest is greater than the market rate of interest. In this case, the 7% bond is more attractive, and investors will be willing to pay more for these bonds when others in the marketplace are paying only 6%. We'll see that these bonds will sell for a premium. That is, they will sell above face value. To compute the issue price using these new set of facts, we follow the same steps as before. Here we need to go to Table 2. Our N is the 10 years times 2 per year. Our N is still 20. Market interest rate, however, is 6%. We need to divide that by 2. We want to go find I equals 3 in the table. The present value is 55,368. Step 2 will calculate the present value of the interest payments. Recall, it is the face times the stated rate times 1/2 to reflect the semi-annual nature of the bond, the interest payments are $3,500 every 6 months. The present value requires that we go to Table 4. N is 20, I is 3%, which is our 6% market rate divided by 2. Table 4 gives us a factor 14.877, which yields a price of $52,071 as the value of the interest payments. The total value, therefore, $107,439. Because the stated rate is greater than the market rate, this bond is more attractive and investors will be willing to pay a premium to acquire it. It's important to understand this relationship. Let's review. When stated rate is equal to market rate, the bond that's being issued is the same as those in the market. It will simply issue at its face value. If, however, stated rate is less than the market rate, the bond that is being issued is not as attractive as others in the marketplace. In order to entice investors to loan us money, we will have to issue the bond at a discount, that is, less than face value. If, however, the stated rate is greater than the market rate, then the bond will issue at a premium. The example we just looked at, stated rate was 7, market rate was 6, the bond issued at $107,439, which was greater than the $100,000 face value. In contrast, when the stated rate was 7, but the market rate was 8, we saw that the bond issued at only $93,205, an amount less than the $100,000 face value.